You work hard, you're smart, you make plans. Yet somehow, wealth feels like it's always just out of reach. Your neighbor who seems less capable than you just bought a new house. Your college friend who barely passed exams now runs a successful business. Meanwhile, you're reading articles, taking courses, trying to figure out what you're missing. What if I told you the problem isn't your intelligence or your effort? What if the real obstacle is hiding inside your own head, running quietly in the background like a computer program you never installed? Your brain makes thousands of financial decisions every single day, and most of them are working against you. Not because you're foolish, but because your mind operates on ancient rules that helped your ancestors survive in the wilderness, but now keep you trapped in patterns that destroy wealth. Today, we're going to examine the invisible mental barriers that separate rich people from everyone else, and more importantly, how you can recognize these barriers in yourself and finally break through them. Scientists who study wealth and psychology have discovered something surprising. The gap between rich and poor isn't really about money at all. It's about how different groups of people process information, make decisions, and respond to opportunities. When researchers compare brain activity between wealthy investors and struggling workers, they find distinct patterns in how these groups evaluate risk, delay gratification, and learn from mistakes. This isn't about being born with a special brain. It's about developing specific mental habits over time, habits that either multiply your resources or slowly drain them away. The fascinating part is that most people never realize these patterns exist. They go through life making the same financial mistakes repeatedly, wondering why nothing changes, never understanding that their own thoughts are the prison walls. Let's start with something that affects almost everyone. You probably hate losing money more than you enjoy making it. This sounds obvious, but the implications are enormous. Research in behavioral economics shows that the pain of losing $100 is roughly twice as intense as the pleasure of gaining $100. Your brain has a built-in negativity bias that made sense when humans lived in small tribes, where one bad decision could mean death. But in the modern world, this same bias causes you to play it safe when you should be taking calculated risks. You keep money in savings accounts that barely keep up with inflation because at least you won't lose it. You sell investments the moment they show profit because you're terrified of watching gains disappear. You hold on to losing stocks for years, unable to accept the loss and move on. Every one of these choices feels rational in the moment. Your brain is protecting you from pain. But protection from short-term pain often means long-term poverty. If you are new to this channel, please subscribe to this channel. This helps to spread the knowledge to others. Rich people have learned to override this instinct. They've trained themselves to think in probabilities rather than emotions. When they look at an investment, they don't ask how terrible they'll feel if it goes wrong. They calculate the likely outcomes, the potential upside, the realistic downside, and make decisions based on mathematical expectation rather than fear. This doesn't mean they never feel afraid. Fear is human, but they've developed the discipline to act despite fear when the numbers make sense. They understand something crucial that poor people miss. The biggest risk isn't losing money on a smart bet. The biggest risk is letting inflation and missed opportunities slowly erode your purchasing power while you hide from decisions. Playing it safe guarantees that you'll fall behind, because the world keeps moving forward whether you participate or not. Another mental trap that destroys wealth is the desperate need to fit in with the crowd. Humans evolved in small groups where being different could get you expelled or killed. Your ancestors survived by watching what everyone else did and copying it. If the whole tribe started running, you ran too. You didn't stop to analyze whether there was actually a tiger nearby. This instinct is still firing in your brain every single day. When you see everyone around you buying houses, your brain interprets their behavior as important information. If everyone's doing it, it must be safe. It must be smart. So you buy too, even though prices have already climbed to dangerous levels. When you watch friends invest in cryptocurrency and brag about their gains, your brain screams that you're being left behind. You jump in, usually right before the crash, because you couldn't stand the psychological pain of being on the outside. Markets move in cycles specifically because of this herd behavior. Prices rise as more people pile in, creating the illusion that the trend will continue forever. Everyone develops a story about why this time is different, why the old rules don't apply. Then reality reasserts itself. Prices collapse. The crowd panics and sells everything. You end up buying high and selling low, the perfect formula for destroying wealth, all because you couldn't resist the gravitational pull of social proof. Wealthy people have learned to recognize this pattern and resist it. When they see crowds getting excited about an investment, they get nervous. They know that mass enthusiasm usually signals a top, not a beginning. When they see everyone running away from an asset class in fear, they start paying attention because that's often when real opportunities appear. This doesn't mean they're smarter. It means they've developed the emotional strength to stand apart from the crowd and think independently, even when being different feels uncomfortable. There's another way your brain sabotages your wealth that's even more subtle. You value today enormously more than tomorrow. $1,000 in your hand right now feels real, solid, valuable. $10,000 20 years from now feels like an abstract concept, almost imaginary. Psychologists call this present bias or temporal discounting, and it's one of the main reasons most people never build wealth. Your brain evolved to grab resources immediately because our ancestors lived in an uncertain world where tomorrow might never come. If you found food, you ate it now. If you didn't, someone else would, or it would spoil. But in the modern economy, this instinct becomes toxic. Every time you're tempted to buy something you don't really need, your present-focused brain lights up with anticipation. You can imagine the pleasure of owning it, using it, showing it off. That pleasure feels real and immediate. Meanwhile, the abstract idea of having more money in the future barely registers emotionally. So you spend, and you keep spending, and you wonder why you never get ahead. Your brain also has a powerful tendency to seek out information that confirms what you already believe and ignore everything that contradicts it. You probably think you're objective and open-minded. Almost everyone does. But research consistently shows that humans are remarkably good at filtering reality to support their existing views. If you believe you're a good investor, you'll remember your winning picks and conveniently forget the losers. If you think real estate always goes up, you'll notice every article about rising prices and scroll past warnings about bubbles. Your brain isn't trying to deceive you. It's trying to protect your self-image and reduce the cognitive discomfort that comes from admitting you were wrong. But this protective mechanism keeps you trapped in failing strategies. You can't improve if you can't see your mistakes clearly. You can't learn if you only pay attention to information that makes you feel smart. Psychologist Daniel Kahneman spent decades studying how people make decisions under uncertainty. He found that humans are consistently overconfident in their own judgments and abilities. Most people think they're above-average drivers, above-average investors, above-average judges of character. Mathematically, this is impossible. But our brains don't care about mathematics when self-image is at stake. This overconfidence is expensive. You read a few articles about stock picking and convince yourself you have a talent for it. You make a few lucky picks that happen to work out. Your brain interprets luck as skill. Now you're confident. You invest more money, take bigger risks, expand into areas you don't understand. Eventually, reality catches up. Your luck runs out. The losses come. But even then, your brain protects you from the truth by blaming external factors rather than admitting your analysis was flawed. Wealthy people combat this by keeping detailed records of their decisions and outcomes. Not mental records that can be revised and distorted over time, but written documentation that can't be changed. They write down what they believed, why they believed it, what they expected to happen, and then months or years later, they review what actually happened. This process is painful because it forces you to confront your errors directly. Your brain hates it. But it's also how you actually improve, rather than just repeating the same mistakes with different details. They also actively search for people who disagree with them. Most people surround themselves with others who think similarly, because it feels good to have your views validated. Rich people deliberately seek out smart people who think they're wrong, because they know their own brain is hiding important information from them. They need outside perspectives to see their blind spots. There's another mental trap that costs people enormous amounts of money. You get anchored to irrelevant numbers and can't let go. You bought a stock at $50 per share. It drops to $30. You refuse to sell because in your mind, you haven't really lost money until you sell. You're waiting for it to get back to 50, back to where you bought it, as if the market cares what price you paid. The market doesn't know you exist. The only question that matters is whether this stock is a good investment at $30 right now. Would you buy it today at this price if you didn't already own it? If the answer is no, you should sell. But most people can't think this clearly because they're anchored to that $50 price in their head. That number has become their reference point for reality, even though it's completely irrelevant to the stock's actual value. This happens everywhere in your financial life. You see a car priced at $40,000. Then the dealer shows you one at $35,000. Your brain thinks you're getting a deal because it's $5,000 less than the anchor. But maybe that car is only worth $30,000. You're overpaying, but you feel like you're winning because you beat the anchor. Salespeople understand this psychological principle and use it against you constantly. They set high anchors to make everything else seem reasonable by comparison. The defense is to completely ignore the first number you hear and do your own independent analysis. What is this actually worth? Not what are they asking, not what someone else paid, not what it cost last year. What is it worth today based on its actual characteristics and the current market? Another psychological pattern that keeps people poor is envy. Not greed, which at least motivates you to want more for yourself, but envy, which makes you obsessed with what other people have. Your neighbor buys a new car. Suddenly your car, which was perfectly fine yesterday, feels old and embarrassing. You feel a pressure to keep up, so you buy a new car you can't afford. Your coworker gets a promotion and starts talking about their higher salary. You feel inadequate, so you spend more on clothes and restaurants to feel successful. Your friend posts vacation photos from an expensive resort. You feel like you're missing out on life, so you book a trip you can't afford and put it on a credit card. None of these purchases made you happier. You didn't even want them until you saw someone else had them. But envy converted you into a spending machine, and it's draining your ability to build wealth. The insidious thing about envy is that it never ends. There's always someone with more. You buy a nice car, but someone has a nicer one. You get promoted, but someone got a bigger promotion. You take a vacation, but someone went somewhere more exotic. You're running on a treadmill that speeds up every time you think you're catching up. Meanwhile, all the money you're spending to keep pace with others is money that's not invested, not compounding, not working to build your actual future security. You're sacrificing real wealth for the appearance of wealth, and the appearance doesn't even make you feel better because comparison is endless. Research in psychology consistently shows that people who focus on relative status, on how they compare to others, are less happy than people who focus on their own absolute well-being and progress. The act of comparing yourself to others activates stress and dissatisfaction, regardless of how much you actually have. Wealthy people have learned to ignore social comparison. They define success on their own terms and live according to those definitions. They genuinely don't care what their neighbors think about their car, or their house, or their clothes. This sounds easy, but it's extraordinarily difficult in practice. The social pressure to keep up is constant and intense. It takes real strength to drive a modest car when you could afford better, to live in a normal house when others expect you to upgrade, to wear regular clothes when people judge success by appearance. But this freedom from comparison is what allows rich people to keep their money instead of spending it to impress strangers who don't actually care about them. Warren Buffett lived in the same modest house for decades, not because he couldn't afford a mansion, but because he didn't need external validation. He defined enough for himself and stopped caring about more once he reached it. Your brain also loves stories and patterns, even when they don't exist. After any market movement, financial news creates a narrative to explain it. Stocks rose today on strong earnings reports. Stocks fell today, despite strong earnings reports. The same data gets spun into opposite stories depending on what the market did. It all sounds logical and convincing, but most of it is just storytelling grafted onto random noise. The problem is your brain learns from these stories. It creates rules and patterns. When earnings are strong, stocks go up. Except sometimes strong earnings lead to sell-offs because they weren't strong enough relative to expectations. Your brain oversimplifies reality, creates false patterns, and then you make decisions based on those false patterns and lose money. This is why people who watch financial news constantly often perform worse than people who ignore it completely. They're filling their heads with convincing narratives that have no predictive power. Rich people learn to ignore stories and focus on fundamentals. They don't care what narrative the market is telling today. They don't care what explanation journalists create for short-term price movements. They understand that most of what happens day to day is noise, random fluctuation that means nothing. What matters is the actual underlying value of businesses over years and decades, not the stories people tell about daily changes. They develop the discipline to tune out the constant chatter and focus on the small number of things that actually matter. This is harder than it sounds because your brain craves stories. Stories make sense of chaos. Stories provide comfort by suggesting the world is predictable and controllable. But in markets, most stories are illusions that cost you money if you believe them. Philosopher Aristotle observed over 2,000 years ago that people who have too much wealth often become unwilling and unable to submit to authority or accept limits. They grow up surrounded by luxury and compliance, never learning discipline or delayed gratification. This creates a particular psychology among the wealthy that's worth understanding. Some people who achieve wealth develop a sense that normal rules don't apply to them. They begin to see other human beings as tools to be used, rather than people with their own dignity and worth. They surround themselves with employees, assistants, and advisors who agree with everything they say, creating an echo chamber that reinforces their belief in their own brilliance. This can lead to spectacular failures when reality eventually intrudes on their carefully constructed bubble. Not all wealthy people fall into this trap, but enough do that it represents a real psychological danger of wealth. The same mental habits that help you build money, confidence, decisiveness, willingness to go against the crowd, can become toxic when taken too far. Confidence becomes arrogance. Decisiveness becomes impulsiveness. Independence becomes isolation. The key is maintaining what psychologists call intellectual humility, a clear understanding of what you know and what you don't know. The smartest investors are often the ones most willing to say, "I don't understand this well enough to have an opinion." They pass on opportunities that might have made them even richer because they know the limits of their competence. They understand that confidence outside your area of expertise is just arrogance wearing a disguise, and arrogance is expensive. So how do you actually change these patterns? Knowing about psychological biases doesn't automatically fix them. These tendencies are emotional, not intellectual. They happen fast, automatically, below conscious awareness. Your rational mind is slow and takes effort to engage. Most of the time you're running on autopilot, and autopilot is programmed with all these wealth-destroying biases. You need systems that force your rational brain to check your emotional brain before making important decisions. Start with this simple rule. Never make a financial decision in the moment. Never. Wait at least 24 hours. Sleep on it. Your emotional mind might be caught up in excitement or fear or a compelling story or social pressure. But after sleeping on it, your rational mind gets a chance to engage, to analyze, to check for biases, to think it through properly. Another practical tool is keeping a decision journal. Before making any significant financial choice, write down why you're doing it. What do you believe? What are you assuming? What would have to be true for this to work? What could go wrong? Then months or years later, review what you wrote. Were you right? Were you wrong? Where was your thinking accurate, and where was it flawed? This is how you get better over time. This is how you identify your personal biases and learn to correct for them. Most people never do this. They make decisions, forget what they were thinking at the time, and never learn from their mistakes. They repeat the same errors for 40 years with different details and wonder why their financial situation never improves. Create a checklist of questions to ask yourself before any major decision. Am I being influenced by what everyone else is doing? Am I anchored to some irrelevant number? Is this based on actual value or just a compelling story? Am I holding on because of sunk costs? Am I overconfident about something I don't fully understand? Am I doing this because of envy or comparison? These questions force your rational brain to engage. They interrupt your autopilot. You don't have to be perfect. You just have to catch yourself often enough that you stop making the biggest mistakes. Even catching yourself half the time will dramatically improve your financial outcomes over a lifetime. Actively seek out people who disagree with you. Your brain naturally seeks confirmation, so you have to artificially create contradiction. Before making a big decision, find someone smart who thinks you're wrong. Listen to them. Really listen. Don't just wait for your turn to argue. Try to understand why they see it differently. What do they know that you don't? What are they seeing that you're missing? This is uncomfortable. Your brain hates it. But it's essential because your brain is showing you only what confirms your beliefs. You need someone else to show you the other side. The best investors surround themselves with people who challenge them constantly, who point out flaws in their thinking, who aren't afraid to say when the emperor has no clothes. Start small with changing your psychology. Don't try to fix everything at once. Pick one bias, maybe loss aversion. For the next month, just notice every time you make a decision based on fear of loss rather than probability of gain. Just notice it. Don't even try to change it yet. Just become aware of when it's happening. Once you can see it operating in real time, then you can start to override it. But you have to see it first. Most people never see their own biases in action. They experience the emotions and make the decisions without ever connecting the dots. Awareness is the first step toward change. The fundamental insight is this: getting rich is not about secrets or shortcuts. It's about thinking correctly. And thinking correctly is not natural. Your brain is wired in ways that made sense for survival in ancient environments, but keep you poor in the modern world. Every single day, your psychology is working against your financial interests, making you follow crowds, fear losses, spend today, believe stories, hold grudges against sunk costs, and compare yourself to others. These aren't character flaws, they're human nature. Everyone has these tendencies. The difference is that some people become aware of them and build systems to override them. Those people accumulate wealth. Everyone else works hard and wonders why they stay broke. You now understand how your own mind has been sabotaging you. You know the specific traps. You know why you make the financial mistakes you make. More importantly, you know how to build systems to protect yourself from your own psychology. That puts you ahead of almost everyone, because most people go through their entire lives being controlled by these biases without ever understanding what's happening. You have a choice now. You can ignore this information and keep operating on autopilot. Keep making the same emotional decisions that feel right but keep you poor. Or you can do the hard work of building systems, overriding your instincts, and thinking like wealthy people think. Not because you're smarter than everyone else, but because you understand psychology and they don't. The difference between building wealth and staying broke comes down to this choice. Choose wisely. If you enjoyed the video, please like it and share your thoughts in the comment. If you are new to this channel, please subscribe.